So a order block, okay, is a change in the state of delivery. Okay, it is not a zone. It is not every down closed candle that is an order block. It is not an up closed candle. Every single one is an order block. It is a frame of reference where a change in where price will be drawn to or from, that occurs here. Why am I using this down closed candle and not this one over here? This one has the larger body. So it spent more time and recorded more time and duration at its extremes. That lowest close, that makes this an order block. This swing high that it's part of, when it trades above it here, that's a shift in market structure. So that means high frequency trading algorithms will trip to buy side, and they'll all be looking primarily for the largest leverage to be on this side of the marketplace. Now, the chaos high frequency trading algorithms that trade up and down all day long, they'll take this trade too, but they'll also take this short in this fair value gap here that trades to it and trade back down into this inefficiency and change in the state of delivery, which is that opening price. Don't believe me? Look. Here's the opening price. He'll never call this stuff live. You'll never see him do it, folks. Yep, I'll do it with a 15-second chart just to rub it in your face. The opening price, fair value gap. How do you qualify a high probability order block? It will have my fair value gap. Not every down closed candle is an order block. Not every down closed candle with a fair value gap like this is a long. Wait, that's a contradiction. No, that's a refinement. I'm teaching you narrative, logic, framework. The fact that we had this idea here, what was the first side of liquidity taken at CPI? We opened here at 8:30. It opened, rallied up here, stopped short, and then went down below to take the buy side. I'm sorry, to take the sell side. So which side of the marketplace did the algorithm run to first? What do smart money players, the folks that don't write books, that aren't going to be talking to you, I'm it. I'm the one that stepped out. I'm not supposed to be doing these things. You're not supposed to know these things. So I have to create a language. So that way, if I'm tapped on the shoulder again, I am teaching this. I'm not teaching that. It's Pepsi or Coke. They're both colas. They're both poison. Okay? But you have a choice. So you have what? A delivery to sell side first. So smart money, the folks that understand the algorithm, the folks that follow its lead, wait for this signature here. Because the first, that tells you the direction. Because they're going to run for sell side first. This is the reason why I told you I believe it's going to go up here. How did you know that, ICT? How did you know it's going to go higher? Why did you pick that? Why didn't it want to come back down to consequent encroachment of this wick? That's what some of you are probably thinking right now. Holy crow, he just read my mind. You're looking around the room right now for microphones, aren't you? I bugged your computer, right? I'm hacking your system with the ghost of the machine. It doesn't need to go down to the consequent encroachment of this because the narrative is it ran for sell side and then quickly repriced away from it. It does not need to come back down here before it goes up to the buy side. And how it delivers, listen folks, how it delivers price after the second pool of liquidity is engaged. Sell side was below here. I'll go back up to the higher time frames in a moment. For now, I have to outline all this. The sell side was taken first. That means the move will be likely prolonged and much more prominent to the buy side. That means it's going to go higher. It upsets the orders and sentiment by this drop down here. Then it runs for the buy side. It breaks lower, comes back up, and then creates a false shorting opportunity. It delivers a short run. Traders see that we're short. They're thinking, yeah, wow, I got 4 handles, 5 handles or so. I'm getting ready to take out that low down here. It's going to keep going for the rest of the day lower. Wrong. It only reprices to the opening price here at 8:30. I know some of you just can't accept it, but it's all controlled. Opening price, trades down. Look at the bodies. They tell you the story. The wicks did the damage. The body stops right at the opening price at 8:30. The algorithm receives that as information, comes back down to it. There, it stops on a dime, turns around, creates your short-term shift in market structure there. Down close candle, bullish order block, separation here. Come back down into it, hit the order block, respect it, close in the inefficiency, time distortion. All this movement in here, as long as we're not breaking below the midpoint of this down close candle, everything's still a go. What I'm looking at is this range from this high of this candle down to that low. As long as these two candle reference points here have not been breached above or below, all this stuff in here, I'm ignoring every bit of it. I'm not looking at any fair value gap inside of that. I'm not looking at any kind of potential order block, because this range here, that's your dealing range, it will not be anything of any importance or significance unless it trades outside of that range. And because I'm telling you, and as I told you live here, I believe it's going to go higher and take out the high. The first draw is here, and the buy side above this high here. So all these candles from this green candle right above my cursor, all the way until we get to this candle's high right there. So this candle all through till here means nothing to me. I'm not looking at any of those candles and having any respect of anything it's doing, because the return from this fair value gap here, let me draw it out. This is complicated, ICT. I just want to overbought, oversold indicate. I'm not your man then. Go watch somebody else. But you want to understand why the market's doing what it's doing, and you can trust and sleep at night that you know that the stuff that you're learning isn't going to stop. It's never going to be beaten up or victimized by anything better, because there ain't anything better. This is the market. I'm teaching you the market. The market rallies up into that inefficiency again and trades down, only to offer delivery to the order block, close the inefficiency, and then time is spent marking time. That's it. We're in 15-second candles. So it's just hanging around. What is it doing? What do you think's occurring inside of all these ranges in here? Between this candle's high and this candle's low, that's all one order block. What kind of order block? Propulsion block. Look at month 4 content on my YouTube channel. Because it's all of this price action from this candle below, my cursor, all the way over to here, all these candles are inside of this. So my mindset and focus is inside this range. Everything is happening inside it. I could care less, because my mind has already established what the algorithm is going to refer back to is this signature here I've coded. So all of this price action here is irrelevant. It's just marking time, where price has moved in that interval, the highest and the lowest, in the beginning and the ending. That's all it's doing. But my mind as a trader and the analyst is, I'm looking at inside this range here. I want to see this range maintain itself and then eventually break to the upside, which we get right there. Where does it draw to? Where I told you, here. And then what does it do? It stops and then consolidates. What's it doing? What is it doing, folks? Think. The order block, it trades down to it. It's spending time down here for traders that understand what I'm teaching you, that they're not going to go out there in public and raise their hand and say, ICT, is right. This is what we do. They don't want me teaching it to you. Trust me, they don't want me teaching this. So it took a great deal of prayer and answered prayer to have this shown to me in charts, so that way I can convey what it is that's happening outside the chart. The algorithm is not only doing what I'm showing you in candlesticks. There are other things that I know that I can't teach, because there's no way for me to bridge that gap between what you can see in a chart. Like I can't say, okay, if it does this is what, it doesn't work like that. So there's only a limitation of what it is I'm willing to share with you, and you have to be content with that. But I promise you, if you just take a step back and look at what it is I'm showing you, it's light years, way, way, way beyond everything else. You don't need to have this much degree of understanding. But what do you think is occurring in here? The algorithm is allowing time for traders that are in the know, that are real smart money. They're not Wyckoff traders. They're not supply and demand guys. They're not Goldman Sachs guys. Okay? They don't know this stuff. I promise you, they don't know this. It's allowing them to get their orders in before the algorithm reprices. And then it goes to our first point of reference, which is the consequent encroachment of this wick here. Stops. And then spends time. What's it doing? Allowing them to build a larger position. What's the model? Where's price being drawn to? Higher. So it allows them to accumulate more longs. And then as it runs up, they're distributing all their initial entries in here. They're selling it some in here. And then new algorithm entries are in here, accumulating more. And as it runs up, they sell, and that provides liquidity. So there's this dance that's always occurring between inefficiencies and liquidity. Premium to discount, discount to premium, always